Good morning and welcome to Renunciation of U.S. Citizenship Tax 101. My name is Warren Dueck and I'm in our Vancouver office, and I'm joined by my partner Cooper Zhu in Calgary. Good morning, Cooper.
Morning, Warren. Morning, everyone.
So we've got a great subject here. We've got a lot of people online watching us here too. So we'll get moving here. And just some notes here for you. Audience participation, yes, we love your questions. Please submit those online. We're going to take the questions at the end. I don't know if we'll be able to get through all of them, but we'll do our best to do that. There's a survey, and please also take the survey. We're interested in your feedback and comments. And lastly, there is a live transcript. You can use the closed captioning function on your Zoom in order to get the text that we have here. So we're going to cover renunciation of U.S. citizenship. We're going to talk about who's a covered expatriate. We're going to talk about U.S. exit tax, IRS Form 8854. And then also some comments about U.S. tax after renunciation. Now, one of the first questions is, why do people renounce their U.S. citizenship? Of course, there's lots of different reasons why people might choose to do it or to not do that. We're tax people, so we're not immigration lawyers, but we're accountants. We're certified public accountants in the U.S. and chartered professional accountants in Canada. So our focus is on the tax side. And, some people decide they want to renounce their U.S. citizenship because they've lived in Canada their whole life. We have people we've worked with who the closest hospital when they're born was in the U.S. and they were born in the U.S. And as a result of that, they're U.S. citizens, even though they've never lived in the U.S. They may not have any income from the U.S., but they are subject to U.S. tax on their worldwide income. Probably the reason that we think about most for people renouncing their U.S. citizenship is two things. One is cost and the other is complexity. Firstly, because they're a U.S. citizen, they have to file a U.S. tax return every year reporting their worldwide income, even though none of it's from the U.S. And, what happens with people like that is they end up in situations where they might not pay any tax, but they still need to file that tax return. And whether they do it themselves and spend hours and hours doing that, reading instructions in a language that's English, but is hard to understand at best, or if they engage people like ourselves to do that, we do prepare U.S. tax returns. It takes a lot of time and it can be expensive and costly. The second part is just general complexity. Every time you invest in something, someone's going to say, oh, you shouldn't do that, or you can't do that because you're a U.S. citizen. And suddenly figure out where do you fit in this picture is always a source of confusion, because since you live in Canada or perhaps in another country, all the information related to that relates to people in that country, not necessarily U.S. citizens. So the information on advice about what U.S. citizens should and shouldn't do, again, it's complex, and so there's other things there too. There is a lot of complexity in that regard. So I'm going to have Cooper talk to us about saying what does renunciation of U.S. citizenship mean?
Thanks, Warren. Well, this is really a renunciation process. Is an immigration matter, and like you said, we're focused on the tax consequences from renunciation. And generally, if you decide to renounce, you make appointment with the U.S. consulate. You fill out the forms. You meet with consulate. They give you a stamp. You wait for maybe a few months. You will receive a certificate of last year nationalities of the U.S. So the whole process can take a few months. You need to pay some fees. Then after that, you cannot go back to, if you want to get back your U.S. citizenship, that's you need to go through the new process as all of other new immigrants. So renunciation.
So if someone gives up their U.S. citizenship, they go to the back of the line. In other words, they have to start that from the very beginning if they want to become a U.S. citizen. I guess that's right, Cooper?
Yeah, there's no any other shortcut for, let's say, our previous renunciers. You can get back a U.S. citizenship easier. No, so this is a very important decision you need to make. You need to weigh not only for tax reasons. I mean, you should not consider the tax reasons. It's more for other pros and the cons. If you are U.S. citizenship, you're a U.S. citizen. When you travel abroad, you get more protections, and you will have more opportunities to work in the U.S. because there is no limitation for you to go there if you live in Canada currently. So lots of things to weigh in. You need to consider many factors. So like I said, one important thing that the people worry about is, to say, hey, if I renounce, how can I get back to the U.S.? It's easier to travel there, or they can abandon me? The short answer is no. It's just like every other Canadian, citizens. There is no more limitation, but there is a amendment here. We put it here. It's really a provision in the immigration law. They have a clause there. They are saying if you have renounced it for any tax avoidance reason, then they can ban you to enter the U.S. It's very hard to, because the burden of the proof is on the U.S., the Department of State or the Homeland Security. So I read some news in the past, let's say 15 years, there were only 2 people got banned for that entry. But other than that, you don't need to worry about that. There's some talking in the legislation context, some people propose some amendment to that, trying to extend that provision to cover more to the covered expatriate, which is, we will be talking about later, what is covered expatriate, but that did not succeed. So that's something, where it goes nowhere. So don't worry about that, I would say. For the green card holders, that's kind of other sets of immigration law. For the tax purposes, if you your abandonment of your green card, that's kind of the same tax consequences to the renunciation. However, there are some limitation there, conditions you have to meet before you walk into the tax trap. We're gonna talk more later with details. So that's the immigration part. Of the tax part, like I said, there are many tests they distinguish if you renounce. For a tax point of view, you can be covered expatriate. Covered usually it means a trouble, because you will have more tax filing obligations, or you need to pay more tax. I will explain more detail later. If you're not covered, usually it's no problem. You just walk away. Then just will be treated as a non-U.S. person, for any tax reasons, for any tax consequences. Usually just U.S. source income, you will be subject to the U.S. tax later on, not for any current assets or worldwide income. So Warren, you want to walk through the next to explain what is covered expatriate?
Yeah, before we do that, I just want to talk a little bit about the Reed Amendment and remind our audience that we're not immigration lawyers, so we're tax people, but there is an immigration aspect here. Just the one comment about the Reed Amendment is that the Department of State in the U.S. has instructed its embassies and consulates around the world that the Reed Amendment, they don't believe it's constitutional. That's never been tested in the courts, but as a result, that's why Cooper mentioned that there's only been 2 cases, and they're all kind of under kind of odd circumstances. So, well, we can't tell you not to worry about it. It's definitely something that's kind of out there that is, I would say, unlikely to affect someone who renounced their U.S. citizenship. And its background is quite interesting. The Reed Amendment that came around back from Facebook in its prior life, but now Meta. That one of the founders was a Brazilian who became a U.S. citizen, and then before it actually went public, and he suddenly went from being worth, you know, mere millions to billions of dollars, he renounced his U.S. citizenship, and that was all around the same timing. And so, you know, you need to be conscious of the immigration side, and certainly if you have concerns about that, we encourage you and can direct you towards immigration advisors. So Cooper mentioned about covered expatriate. You know, anything with a special name in the tax world probably is a bad thing. And a covered expatriate can be that in most cases. It's not always. But so who is a covered expatriate? This is someone who either is renouncing their U.S. citizenship, or they're abandoning their green card and their long-term residence. Now, a long-term resident is a defined term in the Internal Revenue Code under U.S. tax law. It means that someone's actually had a green card in 8 or more years in the last 15 years. And 8 or more years can be actually 6 years and 2 days. So if you got your green card on December 31st of 1 year, that's counts as 1 year. So it's any part of 8 years, you'd be a long-term resident if you hold a green card. And you have to meet one of the following. Sorry, go ahead, Cooper.
Yeah, I was just want to ask, people may ask, you know, what if I work there in the U.S. with some work visa, or, you know, then after a few years, I apply for green card, I got it. So is there any clarification there that those green card period will be counted as this time?
Those periods do not count. So it's when you get the green card is the critical aspect. When do you get that green card? Not that you worked in the U.S. before, not that you went to school there or worked on a visa or were illegally present in the U.S. The issue here is all about that green card. Great. So yeah, if they fit into one of those 2 categories and they meet one of the following tests here, they're going to be a covered expatriate. They'll be a covered expatriate if their average annual U.S. tax liability exceeds $178,000 for the last 5 years. So this is an interesting test because this is net of foreign tax credits. So if you're a U.S. citizen living in Canada, even though you may make several $million a year, well, it's not impossible for you to have a average U.S. tax liability of over $178,000. It's fairly unusual because in most cases, Canada gets to tax that income first, even though it may be from U.S. payers, and then the U.S. gets to tax after that. So that's a fairly high threshold. It's not impossible to reach. And if someone's filing joint tax return and their spouse earns all the income, they get attributed that income for the purpose of this test. So again, that there's some planning opportunities here associated with that. Now, the one that usually trips up people is the net worth. If their net worth exceeds $2 million US, they are a covered expatriate if they either renounce their U.S. citizenship or they're abandoning a green card and they're long-term residents of the U.S. If their net worth exceeds $2 million. Well, you know, that's the price of a single family home in Vancouver. So, you know, that is a really problematic situation there. And again, there's planning opportunities here. And we're going to talk about those later. But if your net worth exceeds $2 million, you would be a covered expatriate if you plan to renounce. The last one here is if they fail to certify 5 years of federal tax filings. I repeated that, it says 5 years twice there. But so in order to avoid covered expatriate status, you need to certify that you've actually filed complete U.S. federal tax returns. What I mean by complete, or what the law means by complete, is that you actually filed returns that made all the required disclosures. That includes disclosures of financial accounts outside the United States. That includes, showing the ownership you might have in a Canadian corporation or in Canadian mutual funds, or that you're a beneficiary of a trust outside the United States. All those things require disclosure. For people, a lot of people say, well, you know something, I don't want to be a U.S. citizen. I've never filed a U.S. tax return. I'm just going to renounce. Well, that may be kind of a disaster doing that, because they're now incurring more tax liability. We'll talk about this in a moment, about what are the implications of being a covered expatriate. But they really need to, before they renounce, at a minimum, make sure they've filed 5 complete years of U.S. federal tax returns. And that could include filing under some of the IRS's streamlined filing programs, which waive all penalties associated with delinquent tax. So there's opportunities here to do this.
So Warren, for that 2 million assets, my understanding is, taxpayer cannot get inflation adjusted amount every year, kind of upwards, you get more exemption. So it's too bad. $2 million.
$2 million, and it includes your principal residence.
Yeah.
It includes a pension plan that you may be a beneficiary of that's going to pay you, let's say, $50,000 a year. There's actually, charts to compute what the value of that is. And, if you're going to get $50,000 a year, I'd say roughly the value is probably going to be something like $500,000 over time, and it's actually adjusted and things like that. So that $2 million threshold is typically the biggest problem for people. But there are planning opportunities associated with that. Now, there's 2 groups of people at the bottom of the page who are not subject to those first 2 tests. In other words, they're not subject to the $2 million test or the $178,000 test on average annual U.S. tax liability. Those are people who are either dual citizens at birth. They have to meet some other tests there too. They have to have been resident outside the U.S. at the time they reside in the country that they're a citizen of. So if they're a citizen, they're born a citizen of Canada and the U.S., they must reside in Canada when they terminate their U.S. citizenship. But they only have to be a resident at that point in time. Or if they renounce before they're 18 and a half. So I call these ones and you'll have to excuse me for this, it's get out of jail free card, because all they have to do is file 5 years of tax returns.
So so that dual citizens at birth, you mean, because sometimes we cross client who, let's say, who are dual citizens at birth in Canada and the U.S. Got 2 U.S. citizenship, and 2 citizenship. But later on, he moved to a 3rd country, let's say UK, Australia, work there, set up family, then want to renounce in that country. So that would be a trouble.
Well, for someone like that, what they have to do is they actually have to come back and become a resident of Canada when they renounce. So, I mean,
right.
There are some obstacles there, but depending on what it might cost you to avoid that, if you happen to be a billionaire, that may be a very inexpensive process to actually become a resident of Canada for that period of time when you renounce. So there are plenty of opportunities. This is all very much based on what happens to those individuals.
That's great.
So
also for the 18 and a half years old, that's short window, because before 18 years old, you cannot renounce, or your parents cannot bring you to the consulate to renounce. So you have only a 6-month window to do that important
Yeah.
decisions. Then sometimes it's hard to get an appointment with consulate.
So we've talked a little about who is a covered expatriate, but we haven't said what happens if you're a covered expatriate. So Cooper, I'll let you go with this.
Yeah,
Exit
so
tax.
generally, it's kind of similar to the Canadian departure tax, not departure tax. I mean, it's kind of, yeah, departure tax. It's like a capital gain recognition regime. You treat it as a deemed disposition of your worldwide assets. So, any deemed gain will be subject to tax for that year during which you renounce. And the gain amount could be huge. The good news, you get some exemption here. Again, here there's some inflation adjusted amount. So $767,000 US dollars you can claim as exemption, but any gain above that, you need to pay tax on the capital gain rates. In the U.S., for the U.S. tax purpose, you get a long-term capital gain rate, which is more favorable to the clients. And if it's short-term within 1 year holding period, that capital gain will be subject to ordinary tax rates for the U.S. tax purposes. Then there are some exemption or default in the tax code. Usually it's not, you cannot claim to those exemptions. Let's say principal residency or like a 1031 like kind exchange. So those provisions, that's relief you're not entitled to. So it's too bad. But good news for green card holders, because before the green card status, you were not a U.S. person. So at that moment, the U.S. allow you to bump up your basis to calculate the capital gain in this context. So that's good news. You need to kind of claim that bump up the basis to minimize or reduce your capital gain tax. So that's the overall. I mean, there is more details, and there's some pensions before the compensation. Warren, you want to explain that part?
Yeah, well, just before I jump off this page, Cooper, you made the comparison that Canada has a departure tax. And what I would suggest to our viewers here is that Canada's departure tax is a little bit toothless. It sounds way worse than it actually is, because if I leave Canada, I'm subject to this departure tax on any appreciation of my worldwide assets. As long as I provide security to Canada Revenue Agency, I don't have to pay that tax. And there's no interest charge. So, I could take my $1 billion and go live somewhere else. But as long as I give Canada Revenue Agency security, I don't have to pay the tax. The U.S. allows you to defer the tax too, but it charges an interest rate on it. So that costs you real money to do that. And so the U.S. exit tax is far more significant than Canada's departure tax. And like I say, really costs you money to do that. There's two things in life that are certain, right? Death and taxes. Whether you leave the U.S. or renounce your U.S. citizenship, or you leave Canada, you're going to pay tax on that income or those gains at some point in time. But how much does it cost you until you do that? And the U.S. exit tax is high in that respect. So we'll flip over to deferred compensation, and this really involves, retirement plans, pensions, whether they're U.S. plans or non-U.S. plans, and any compensation that comes to you from performing services. So even though you might not get paid right away, it would fall into this. And what happens basically is this: is you're subject to tax on those amounts in the year at the date of departure, that you cease to be a U.S. citizen or you abandon your green card. So bang, you have to pay tax on the full amount. You say, well, I've got a pension, I'm going to get paid $50,000 a year, but this would force you to pay tax on it when you actually cease to be a U.S. person. There's a 30% withholding tax. Tax treaty relief may apply in certain circumstances. The big exception to this rule is that if you receive something called eligible deferred compensation, because it defers the tax until it's actually paid to you. That's usually what we're used to. We don't actually pay tax till we receive the money. The deemed distribution taxes it as if you did receive it, but if it's eligible deferred compensation, you're only taxed when actually paid. It requires an election. It must either be a U.S. payer of that amount, or the foreign payer can be elected to be taxed as a U.S. payer. Now, the challenge is going to be when you're talking about non-U.S. pension plans or deferred compensation. Is your employer, is your employer, a Dutch company? Are they willing to be treated as a U.S. payer for this purpose? I would suggest to you that a lot of cases, companies will be unwilling to pay those amounts or to make that election. So that's a challenge in those circumstances. Cooper, you want to talk about our next category of tax then?
Yeah, the U.S. exit tax. We just talked about Canadian. I think it's next slide, or and
yeah, I actually noticed we have a slide that disappeared here.
Okay,
But maybe that's a short one here. Do you want me to talk about specified accounts?
Specified account on the. Oh,
yeah, well, there's a
exit tax. This is more interesting. The tax on covered gifts and the bequest.
Sure. Well, why don't you go ahead on this one?
Yeah. This is a interesting topic. People often overlook it. They only think about go to renounce, get out of the U.S. for now, but taxpayers sometimes often forget, after 20, 30, 50 years, your assets will be passed to your next generation or next generation, who may have some U.S. citizenship or resident status by then. So this is a provision in the tax code to kind of to catch you on the future tax. You can walk away with your assets for now, but later on, when you gift assets to U.S. citizens or resident, your sons, your grandson, or charities, then the U.S. recipient, they will be liable to pay the tax. And of course, there is a condition here. You have to be covered expatriate first. If you don't fall into that 3 tests we walked through before, the net worth assets, tax liability test, and the certification test. If you don't fall in those, you're fine. You can give the assets later on to the U.S. Family members. That's totally fine. However, if you're U.S. covered expatriate, you want to gift anything, or when you passed away, your U.S. beneficiaries will receive something from your estate, then it will be subject to 40% tax. So the liability for this tax is on the beneficiary, not you or your estate. So people say, hey, then can I just set up a trust either in the U.S. or the foreign country to avoid these? No, because legislators didn't know how you play these tricks, So in the tax code, they said either direct gifts or bequests or indirect. So the both categories will be subject to the same this exit tax we call it. And the IRS is working on updating a form called 708, and it's a new form. If you have filed form 709, which is the U.S. gift tax return. So this is the form just next to it. It's called 708. So stay tuned for this and watch out for this tax trap when you think about renouncing your U.S. citizenship or abandoning your green card. You need to think about whether you have some U.S. family members in the future. You want to give some assets to them.
So this is a really significant provision here, this the tax on covered gifts or bequests. So, if I'm a covered expatriate and I come back to Canada and, maybe get married, have some children, and one of my children go live in the U.S. and I, on my deathbed, I send him $1 million, something like that. He's got a 40% tax. So when someone renounces their U.S. citizenship, if they're going to be a covered expatriate, there's some really significant implications there that you may not know about for years. And that's why you really want to avoid covered expatriate status. This is a really significant item.
Yeah,
so I mentioned
little notes here, people still get a little bit free gift room every year, but it's a negligible. It's just like $16,000 a year. That's a tax-free gift. Every U.S. person can give that amount to anyone. It will not subject to U.S. gift tax, and it will not reduce your lifetime estate or gift lifetime exclusion amount. So, but that would not help anyway, just a little bit.
So if I'm a covered expat and I make a gift of $16,000 to my son living in the U.S., then they're not subject to that provision.
That's right. It's tax-free, the basic amount.
But if I give him $1 million, that's well above the 16,000, and now he's got a $400,000 tax to pay. And the criteria here is not that the recipient lives in the U.S. They either are a U.S. resident or they're a U.S. citizen. So the child that you had when you were living in the U.S. who now lives in Canada and is a U.S. citizen has that same tax liability if you make a gift to them. So you need to be really careful about this provision. And this is where, we try and avoid covered expatriate status if at all possible.
Yeah, also the assets amount is not limited to whatever the amount when you renounce your U.S. citizenship, let's say. By then you had $50 million. But in 10 years, when you make the gifts or make the bequest, it could be $100 million. So this tax is on the whole, whatever the amount, it could be $100 million. It's not limited to the original amount when you renounce. So
right, yeah,
so all of the future appreciation.
Yeah, exactly. I'm just going to make a quick comment on two things that we seem to have misplaced the slide here. There's two other categories that are subject to the U.S. exit tax. One of them is for something called specified tax deferred accounts. And that would apply for an individual retirement account. And it would apply for a 529 plan, which U.S. people may be familiar with, that is for education savings. There's also some other ones that are applicable to it. It has results that are very similar to our earlier slide about deferred compensation. They're similar, they're not identical. There's also provision here about payments from non-grantor trusts. Now, that's a subject all by itself, but be aware that the U.S. exit tax is quite comprehensive. And really, in most, I would say almost in all situations, you want to avoid being a covered expatriate to the extent you can. So let's flip over to some planning issues for renunciation. Gifting to avoid $2 million of net worth. If you make a gift to your spouse, if your spouse is a U.S. citizen, you can give an unlimited amount to that spouse. But if your spouse is not a U.S. citizen, they have a limit. In other words, this is about the citizenship of your spouse, not residency. But you could make a gift to your spouse. If your spouse is a U.S. citizen and you both want to renounce, then typically what would happen is, let's say her net worth is under $2 million, she would renounce, but your net worth is above $2 million. Before you renounce, you could actually make a gift to her. There's some limits on that as to that gifting amount. And but you can make a gift to her to get you under $2 million, and then you'd avoid the $2 million threshold. There's also, with respect to the $178,000 U.S. tax test, is where one spouse is high income and the other is low income. You might want to file separately, or even just wait for some period of time for that threshold to be to get under $178,000, so your average tax liability over 5 years wouldn't be applicable. If you haven't filed tax returns, like this is pretty much a no-brainer. You want to file U.S. tax returns at least 5 years before you renounce your U.S. citizenship or potentially abandon your green card. If you are a green card holder, I mean, the first thing we advise people here is don't get a green card unless you're required to get one or you have no other choice, but avoid getting that green card, because as soon as you get a green card, that clock starts ticking. And once you meet that 8th year, you're into U.S. exit tax potentially. If you do have a green card, you should think about leaving the U.S. before you get to the 8-year mark and stopping being a U.S. person. You may want to trigger some tax events before renunciation, because that may give you a better result about the principal residence exemption. That if you trigger that before you renounce your U.S. citizenship, you could get the benefit of that principal residence exemption, but you can't if you hold on to that during the period you own it. Valuations discount, this is especially problematic for small businesses, is you say your business is worth $10 million, but you own it with a group of other people, you're a minority shareholder. You may own 20% of the business, but your 20% isn't worth 20% of the $10 million because you're a minority shareholder. And so there may be some discounts that are applicable on valuation. There also may be, the unusual thing is there may be a circumstance, say, I actually want to be a covered expatriate. And that could occur where, for example, you've got some U.S. real estate, but exempt if you're a covered expat, you get to exempt $700,000 of gain on that, $767,000 a gain when you expatriate. But so there could actually be a circumstance where it makes sense to be a covered expatriate. That's a pretty unusual situation. So Cooper, we got some other things to watch out for. You want to talk about that a little bit?
Yeah, this is something we need to think about carefully when we consider renunciation, especially when we think about that 3 tests you just mentioned. For asset test, $2 million, you mentioned there's some strategies, including gifting, but however, in some states, let's say, or if you have some community property rules there. You, people often overlook these rules to think either I have 100% of assets or I don't have any. So I think you need to think about community property rules. Sometimes for some properties, you're entitled to 50%, let's say compensation or some other properties. So you need to consider these. Also for gifting to non-US citizens.
Can we just talk about community property for a second? There's several Western US states, most that have community property laws. And so if you live in California or Washington, that's two of the closer ones to us here in Western
Texas, a few, yeah.
Yeah, so that means that when your spouse brings home a paycheck for $100,000 in a community property state, even though the check is made out to them and it's on their employment income, each spouse gets $50,000 of that. And that not only includes the income they earn, but the assets they acquire. This can be an opportunity. It can also be a problem.
Exactly. And sometimes, I mean, those rules are not in the tax code. You need to look some other set of other laws to figure that out. So it's quite complicated. There's some exemptions, inclusions, lots of details to dig in. And talking about the gifts, to non-US citizen spouse, you get a higher amount. You will not get a higher like a US spouse amount, but it's way more higher than the annual tax-free amount, let's say $16,000 or $17,000. We just mentioned that. And currently it's like 165 grand US dollar to, let's say, a Canadian spouse. So that's if you plan your renounce, let's say in the next few years, you can give away those every year tax-free to gradually to wind down your net assets. And
so Cooper, if my spouse is not a US citizen, I can give her an unlimited amount of money, but if I give her more than the threshold, you said it's 165,000 for 2022?
Yeah, it's inflation adjusted. Every year get a little bit, a few $1,000s more. Yeah.
I don't try and memorize numbers either, but let's say it's about $160,000. If I give her $1 million, then $160,000 is free of US gift tax, but the excess over that will be something called a taxable gift, and that will reduce the amount of gifts I can make during my lifetime or on my death if I'm a US citizen. So that's
right.
it, the gift tax and estate tax in the US work together.
Yeah, over that amount, you will not subject to gift tax right away, because like you said, you still have lifetime exclusion amount nowadays, like $12 million. So as long as your total gift is under that rule, you will not be subject to the US gift tax right away.
So if I gave my spouse $160,000 in 2022, and then gave her an additional $12 million in 2022, I would not pay any US gift tax. I'd have a $12 million taxable gift completely covered by my exemption, but every taxable gift I made after that point in time, I would end up paying US gift tax on if I continue to be a US citizen. So here's an opportunity. These are things ways that people can avoid being a covered expatriate. If my net worth is $10 million, I'm over the 2 million. But if I gave 8 of it to my spouse, who's not a US citizen, I could renounce my US citizenship and not be a covered expatriate, presumably I met the other criteria.
That's right. Sometimes you need to watch for the timing. In the past, I had a client in Australia who renounced. Before renunciation, he gave a lot to a spouse. Then after like 1 or 2 months after renunciation, he took back everything on his name. So the IRS, for some reason, send him an examination letter to require, to have a details breakdown for whatever assets you had before your renunciation and after. So it could be subject to some scrutiny there. So just watch for the timing, and that's one part. And also, when you do these, when you renounce, remember there is some deemed disposition capital gain. So sometimes depends on the country it lives in. Let's say in Canada, it could be ending in double taxation because you kind of got liquidation all of your assets for U.S. tax purposes, but not for Canadian tax purposes. So that could be a foreign tax credit or income recognition timing mismatch. So you need to think about that before you renounce. Also, for the assets test, let's say $2 million assets, you're confident that you will be below that test for the next 2 months, maybe. However, it's hard to say in 6 months, in 1 year, depends on the foreign exchange rates. It could change you. I mean, in Canada, you don't get a wide exchange in that part, but in some other countries, high inflation with high inflation rate. So foreign exchange rates can be very different, depends on the timing. Then that will change your $2 million of that assets test, So that's something to watch for. Also, in nowadays, Warren, we had some client, let's say, who has cryptocurrency account. It could be just a small amount nowadays, but it's hard to say in 6 months how much it would be valued. It could be 10 times, 5 times. So it's not like a traditional stock market or mutual funds investments. So you need to plan ahead to consider, to what kind of asset you have. Sometimes when you walk into the consulate for renunciation, it's hard to predict what your net worth at that day. And so we're just kind of run out of the time. We'll go this quickly. For long-term resident test, Warren mentioned, even you have just 1 day in the year you had a green card, that year is counted for that 8-year test. And mentioned before, green card holders can get some benefits by increasing your assets cost basis when you calculate the deemed disposition gain. Warren, over to you for the important form we need to file.
I'll talk a little bit about IRS Form 8854, but before I do that, I don't think we talked about this at all, is just what is the actual process about renouncing your U.S. citizenship? I mean, firstly, you got to make an appointment in Canada with a consulate. I think I want to say there's 5 consulates in Canada. I know Vancouver, Calgary, Toronto, Montreal, and I think Halifax. There was about a 6-month waiting list to get an appointment. When your appointment actually comes, you show up. You have to pay a fee. You have to pay a fee of about $2,500 U.S. to the U.S. government for the privilege of renouncing your U.S. citizenship. There's some fairly basic forms they have. They're gonna check to make sure that one of the things you want to do if you're going to renounce your U.S. citizenship, my advice is you want to be a citizen somewhere. There is no law that says that, but I don't think that's a very good idea, because you could ultimately become a stateless person. If you're residing in Canada and you're a permanent resident of Canada, you renounce your U.S. citizenship, and for some reason you lose your status in Canada, you don't have any place to go to. So you want to become a citizen somewhere else before you do that. You want to have a U.S. passport to do that too. That's going to simplify the whole process to do that. And lastly, when you actually go to the consulate, one of the things that the consular office needs to make sure they determine is that nobody is forcing you to give up your green card or your U.S. citizenship. So they have to make that determination. You can't have someone coming in that's strong-arming you into announcing your U.S. citizenship. They won't do that. And that's why in most cases, you'll have to actually meet with a consular official on your own to do that. It's a lot easier for long-term residents giving up their green card. They basically walk into any port of entry and formally abandon their green card. They'll receive something called an I-407 back. So that's a little bit kind of the process. For people, people need to file IRS Form 8854 if they've renounced their U.S. citizenship. So all renouncing U.S. citizens need to do that. Or they're a long-term resident and they're either abandoning their green card or they're treaty tie-breaking. The provisions of the Canada-U.S. treaty and most U.S. treaties have a tiebreaker provision. And so they all have to file the form. The only time you're taxable to file that form is if you're a covered expatriate. And as we mentioned before, you can elect to defer the tax. You're still subject to it, but you're going to pay in. There's an interest charge there. So deferring the tax is still a painful process to do that. So that's not the world's best situation. If you renounce, you may still be subject to U.S. tax, and I'll let Cooper talk about U.S. tax after renunciation.
Exactly, just like all ordinary Canadians here without any U.S. resident status, you could be still subject to U.S. tax if you have, let's say, U.S. sourced income, usually the U.S. rental income or any salary compensation allocated to the working days you were presented in the U.S., or sometimes it's community property income, like Warren you have just explained. Then sometimes if you spend too many days, in the U.S., it could be triggered the U.S. resident status by default rules. In that case, you need to file the treaty-based return to tie break, to say, hey, I'm Canadian, I have more closer connections to Canada. So in that regard, in that case, the U.S. will allow you to be treated as a non-resident for U.S. tax purposes. One of the important provision here is, in tax law, there is a clause says if after you renounce, if you for some reason, you became a U.S. resident based on how many days or or other reason you are treated as a U.S. tax resident again, then that past 3 years for tax purposes, you will be treated as you have not renounced. So every year, all of your worldwide income will be subject to U.S. tax still. So watch for that. Then we talk about the gifts to U.S. persons. This is important. Section 2801, we just talk about recipients could be required to pay 40% of the tax. So this is just some high, points here for you to consider. I think, Warren, we need to leave some time for our audience questions.
Yeah, thanks, Cooper. So if submitted questions, thank you for doing that. We're going to take them now. Please do complete our survey. We'll send it to you as soon as this is over. We're going to have a question time now. And if I don't have a chance to do it before, thank you for joining us here. Our next webinar is scheduled for June 7th, and it's on business ownership for Americans resident in Canada. This is a real challenging subject in terms of how does a U.S. person living in Canada own a business. So Efrelyn, I presume we've got some questions. My question, Efrelyn Soyanko is going to read us some questions here. So Efrelyn, do you have something for us?
Yes, Warren, we have a lot of interesting questions here. And I just wanted to share with you, Warren or Cooper, to address regarding deemed distribution of deferred compensation. So the question is, my retirement is in defined contribution plans. Will I have to pay the deferred tax on them when I renounce? Another one I would just combine is, does the term pension plans include RRSPs?
So let's just talk about the defined contribution plan. I mean, it would be something called deferred compensation either way. But the only time you're actually paying a tax on that is if you're a covered expatriate. So if you're not a covered expatriate, if you renounce your U.S. citizenship and you have less than $2 million net worth, your average annual U.S. tax liability is under $178,000, and you filed the last 5 years of U.S. tax returns and you certified that, then you're not subject to any tax at all. And if you are, I think the very first thing you want to do is saying, how can I avoid that situation? Now, in some cases that may be easy to do. In other cases, it may be more difficult. So if you've exhausted all those things and now you're saying, am I subject to tax? Yeah, you would be subject to it on that deemed distribution of deferred compensation. And that would apply for RSPs as well. And the secret there then is you want to try and make it eligible deferred compensation that is only taxable then when you actually receive the income, as opposed to on the date you actually renounce your U.S. citizenship.
Yeah, for the pension, just clarify, there's you can defer the tax, but the value of the accounts will be still counted for that $2 million net worth tax. Sometimes for defined contribution account, it's easier to have an account value because based on usually the investment value, you can predict, you have a statement. But for defined benefit account, that's another pension. It's hard to put a concrete number there to say how much it will be valued. Depends on there's some special ways to calculate those.
That's right. You got something more for us, Evelyn?
Yes, I have another one here. So I am a U.S. citizen who owns joint accounts with my spouse, who is a Canadian citizen only. So does that mean that on Form 8854, I would list only half of the balance of my joint bank account, for example?
Yeah, generally that's the case, but the tax law is very, there's some ambiguity there. It could be track of whatever the original fund contribution, let's say you have a house, but the one spouse contributes 100% of the fund. So sometimes from the RS size, it could be 100% on the one spouse's name for that value. So
if you have a husband and wife, and the wife earns all the income, and she deposits her paycheck to that account, that joint account, 100% of that account is hers. Now, the bank will allow that the other spouse, the husband, to withdraw monies from it, but it doesn't make it his from a tax perspective. So, Cooper, I agree with you 100% there, is that who is the owner is not as easily defined as saying that they're joint owners of the account. If one spouse put in all the money, then it's all theirs, even though it's a joint account.
Yeah, maybe in that case, you can give to another spouse to avoid that, to make some documents, just in case the RS will challenge that.
Right.
Okay.
What else we have, Evelyn?
Yes. I think related to the first one we explained, just short question here. Does a spousal RRSP contribution count toward the annual gift tax exemption?
Well, annual gift exemption always be there, no matter spouse, kids, U.S. citizen or not. So you can always get a deduction at the beginning.
Well, it's a gift to the spouse, and you know, it has a bunch of ramifications actually. So yeah, it's potentially a taxable gift, but if the receiving spouse is a U.S. citizen, they have an unlimited ability to gift to a U.S. citizen spouse. But if the receiving spouse is not a U.S. citizen, then it would be subject to the threshold, which we said was normally $16,000. But in the event of a spouse that's not a U.S. citizen, it goes up to about $160,000. So it'd be well within that threshold there. There's no reporting. If it's not a taxable gift, there's no reporting requirement there.
Yeah, for the U.S. tax purpose, it works, but watch out for the Canadian tax consequences, because there's some attribution income tax rules there. It will, kind of claw back whatever the income to the gifter. So there could be some mismatch. So watch for that.
So it's 10 o'clock now, just after 10 o'clock. And those who've been watching, if you need to sign off, I can't stop you from doing that anyways. But thank you for joining us. We'll take a few more questions, Efrelyn, if you got a couple of good ones for us. And other people are welcome to stay on board with us here too.
Right. Could be a U.S. residency question in relation to the expatriation. The question we have here is, how long would you have to stay in the U.S. to trigger U.S. residency? 3 months, 6 months, or longer?
Well, that's we've covered that subject in some of our other materials, and you're welcome to look on the website. We talk about tax residency in some depth there. The simple rule is this: is that you can be a U.S. resident if you have a green card, even though you don't physically reside in the U.S. You can also be a U.S. resident if you have what's called substantial presence in the U.S. And that normally takes, if you have more than 182 days in the U.S. in a year, you'll be a U.S. resident under U.S. tax law. But you can be less than that. That's a little more involved. I encourage you to look back at some of those YouTube ones we've already done in this subject. They go through that fairly exhaustively. I think you'd find that helpful.
Yeah, audience, remember we have a YouTube channel. There's more videos in the past you can explore. Fun stuff. Take one more.
We have
maybe.
another one here. Would be case specific, but you may share your thoughts. Is there any vulnerability of having a Canadian citizen spouse who is very wealthy, but the dual citizen spouse is of average income?
Any vulnerability, was that the question?
Yes.
I think that I'd say the answer is no, but every situation kind of depends on its own facts. I think what we said to start with is being a U.S. citizen has a cost because of the requirements to file. So even if you're the low income spouse, there's a cost. The question really is the cost worth it because the benefit is there? So U.S. tax law will not tax the non-citizen spouse or their assets, but on the death of the non-U.S. citizen spouse, if the surviving spouse gets all the assets, now that estate is subject to potentially to U.S. estate tax and U.S. gift tax. So there's some planning opportunities there that you want to avoid the non-U.S. citizen spouse's assets from now being subject to U.S. tax, but you still want to confer benefits to the spouse who is a U.S. citizen after the death of their spouse. There's a number of ways to do that. One of it could say the U.S. citizen spouse should give up her U.S. citizenship, or the other is, looking at using various mechanisms to put income into their hands without them becoming owners of their estate. So, those are become very specific questions there. So I think we're pretty much at the end of our time here. I thank you for joining us. We appreciate your viewership. Please complete the survey for us. We'd love to learn ways we can address questions that you have better, and maybe subjects you want us to cover. There's an unlimited amount of subjects we could cover here. So we're always interested in getting feedback from you on that. We appreciate you, and thank you again, and look forward to seeing you in the near future.
Thanks,
Thank you.
everyone.